Welcome, everyone, to another deep dive. Today, we're cutting through the noise, getting straight to the critical insights you need from the latest earnings call. It's from a company making some pretty significant moves in the world of work. We're here to give you that shortcut, to be really well-informed fast.
That's right. So just 2 days ago, August 6th, they dropped their Q2 2025 results. And honestly, if the market reaction tells us anything, it's that there's a compelling story unfolding here. We're going to peel back the layers on the financials, dig into those strategic shifts, and really try to understand what it all means for where they're headed.
All right, let's unpack this then. You're about to get the full picture distilled down for, maximum impact in those crucial aha moments. Okay, so right off the bat, what do people need to know? Sounds like it was a good quarter.
Oh, more than a good. You need to know this was an exceptional quarter. Both top and bottom lines, they didn't just meet analyst expectations, they genuinely surpassed them across the board.
Okay, surpassed. So let's get specific. What were the numbers?
Absolutely. Let's look at the numbers. So GAAP EPS came in at $0.24. That's earnings per share using the standard accounting rules. That significantly beat the $1.19 consensus estimate. Pretty good beat there. And then non-GAAP EPS, which often gives a clearer view of the core operations, that was $0.35 against a $0.28 consensus.
Okay, strong on earnings then. What about revenue?
Revenue also impressed. It hit $194.9 million. The consensus was looking for more like $187.7 million. So that's a 3.9% beat against expectations. And importantly, it showed 1% year-over-year growth.
1% growth year-over-year. And their profitability metrics, do they tell a similar story? What stood out there?
Indeed, they did. The profitability was, maybe even more impressive in some ways. Gross margin stood strong at 78%. That's a very healthy figure. Adjusted EBITDA, earnings before interest, taxes, depreciation, amortization, a good proxy for cash flow. It reached a record $57.1 million. That showcases an impressive 29% margin.
29% margin, wow.
Yeah, and what's even more remarkable is that this is a 40% year-over-year increase in adjusted EBITDA. 40%. And free cash flow. That surged to $65.6 million. That's up an astonishing 85% year-over-year.
85%, okay.
So when you put it all together, strong revenue beats, record profitability, massive cash generation, these are genuinely solid numbers, reflects real operational strength.
So, okay, headline numbers look great. Exceptional, as the CEO apparently described it. What's actually behind it? Let's dive a bit deeper into the drivers.
Right. The CEO pointed to two main things delivering tremendous value. First, the success of their AI features. Second, their strategic M&A, mergers and acquisitions, especially in attracting larger enterprise clients. And this positive momentum wasn't just like a one-off thing. It directly led them to raise their full year 2025 guidance.
Oh, they raised the guide. Okay, that's always a key signal. What are they projecting now?
Yeah, exactly. So revenue now expected between $765 million and $775 million for the full year. Adjusted EBITDA between $206 million and $214 million. And EPS between $1.14 and $1.18. And for Q3 specifically, they're guiding revenue to $195 million and EPS to $0.260.28. So yeah, this upward revision, it really shows management's confidence in what they're doing right now.
That's a significant vote of confidence, definitely. And speaking strategy, you mentioned M&A. They've been quite active there lately, haven't they? Sounds like they're not just growing organically, but really strategically adding pieces.
Exactly. Two key strategic moves recently. They closed the Bubty VMS deal in Q2. VMS is vendor management system. And importantly, they signed a definitive agreement to acquire Ascen. That's expected to close later this year, second half. These acquisitions are really crucial. They significantly expand the company's reach, adding full stack contingent workforce offerings, specifically targeting enterprise clients, moving beyond their traditional marketplace focus.
Okay, so bringing these capabilities in-house, why is that such a big deal for them? What does it really unlock?
Right. It's all about unlocking this massive $650 billion enterprise total addressable market, TAM. See, historically, this company relied on partners for certain services like employer of record, stuff like that, for their bigger clients. By bringing these capabilities in-house with Bubty and Ascen, they can get a bigger slice of the pie, deepen their wallet share with these large companies.
Makes sense.
The goal is to offer like a single platform, digitally native, contract agnostic, global, a solution that handles all contingent work program needs. Now, These deals, they'll only have a minor revenue benefit, maybe $5 million in the second half of 2025. And there's about a $10 million hit to adjusted EBITDA in that period too, integration costs.
Ah, okay, so short-term costs.
Short-term costs, exactly. But they're expected to drive meaningful GSV gross services volume, the total value transacted, and revenue growth starting late 2026. And they expect it to be meaningfully accretive to adjusted EBITDA in 2027. So definitely a longer-term strategic play.
Gotcha. Okay, so M&A is one big piece. But you also mentioned AI. The CEO said AI features delivered tremendous value. How is that actually showing up in their product? And, how are they making money from it?
It's a huge focus for them. Their AI work agent, they call it UMA, saw adoption jump 24% just quarter over quarter. And AI-related GSV, that accelerated to 30% year-over-year growth. That's up from 25% in Q1. So accelerating growth.
Wow, okay. What kind of features are we talking about?
They've launched several impactful things, like instant interview and video meeting tools that generate transcripts and action items automatically, helps with collaboration. New AI search capabilities actually drove a 4% lift in average spend per contract and a 3% increase in Connect's revenue. That's the money freelancers pay to bid on jobs.
So direct revenue impact from search. Interesting.
Yeah. They also rolled out AI-driven job posting tools for clients, giving tailored tips. And enhancements to their UMA proposal writer led to a 58% increase in freelancers using UMA to submit bids. So it's clear they're not just bolting on AI, they're really integrating it deep into the workflow, start to finish.
So yeah, AI isn't just a buzzword here. It sounds like it's genuinely impacting core metrics, directly contributing to revenue efficiency. It's really baked in.
Precisely. And look at this. The number of clients posting AI-specific jobs grew 38% year over year. That's a strong signal for future GSV because clients doing AI work spend more than 3 times as much as the average client.
3 times. Okay, that's significant.
Definitely. And prompt engineering GSV alone grew 51% year over year in Q2. Shows a very specific high-growth niche. What's also really fascinating, I think, is that categories people thought might be at risk from AI substitution, like accounting, video production, even contract law, they're actually seeing growth.
Really? How's that work?
It seems to be because of AI augmentation. AI isn't replacing the humans, it's enhancing their creativity and judgment, making them more productive. Now, sure, some simpler tasks, maybe basic writing or translation, are seeing some substitution. But overall, GSV from even those categories is outperforming expectations. So AI is playing this dual role, efficiency and augmentation. It's not just replacement.
That's a really interesting dynamic. Augmentation driving growth in unexpected areas.
Okay, what about their Business Plus offering and just the overall marketplace health beyond the AI angle?
Right, Business Plus. That's their premium plan for larger SMBs and teams. It's clearly resonating. Active Business Plus clients increased a remarkable 45% quarter over quarter. 45%
Q over Q. That's huge growth.
It is. And the GSV from those clients surged an impressive 190% quarter over quarter. And get this, 35% of these Business Plus clients in Q2 were entirely new to the platform.
Oh, wow. So it's attracting fresh demand, not just upselling. Exactly. That's a powerful indicator. And their other monetization levers were strong too. Ads and monetization revenue grew 17% year over year overall. That included a 19% increase in that Connects revenue we mentioned, and 13% growth in Freelancer Plus subscription revenue. That's the premium plan for freelancers.
Okay, so multiple levers working. What about the take rate?
Good question. The marketplace take rate, the platform's cut, reached 18.5% in Q2. That's up from 18.0% a year ago. They mentioned that's partly due to some experiments with variable freelancer fees. Overall, GSV was $1 billion, stronger than expected. Average GSV per active client grew 5% year over year, and it surpassed $5,000 for the first time since 2022. And hours per contract also hit an all-time high. So bigger, more complex projects seem to be the trend.
Okay, lots of positive metrics there. But I thought I heard something about client counts. That seemed to be maybe a bit of a tension point for analysts. Can you elaborate on that?
You're sharp to pick up on that, yes. While the company is clearly focusing on higher value engagements, larger clients, the active client count did continue to decline. And that does reflect cumulative top-of-funnel demand pressure from previous quarters. And yes, you're right. This is certainly a point analysts are watching closely. They're wondering if it signals a broader issue.
So how significant is this decline? And I guess Are analysts really buying the quality over quantity explanation? Is there a risk this could eventually bite them, even with the focus on bigger spenders?
That's the core question, really. Management emphasizes the strategic shift to higher lifetime value clients. That's the narrative. But yeah, some analysts are looking for clear signs that maybe the decline is bottoming out or that new acquisition channels are really starting to fill that funnel again. The company acknowledges the pressure, but highlights they're actively addressing it, focusing marketing spend differently, testing new channels beyond just, standard Google ads. And they'd argue this refined strategy is paying off in other metrics, like that overall spend per contract. That grew for the third straight quarter, up 11% year over year in Q2 to an all-time high. So it's a strategic trade-off they're managing, prioritizing revenue per client over sheer client volume. But yeah, definitely remains a metric everyone's watching.
Right, a calculated pivot they need to execute well.
Yeah.
So with all these internal levers, the AI, M&A, client strategy, how are they viewing the broader macro environment? Seeing tailwinds, headwinds, or just kind of navigating?
They describe the macro environment as still unpredictable, no significant changes from the prior quarter. That slower acquisition environment, well, it continues to weigh on those active client metrics we just talked about. However, management really emphasized that their strong Q2 performance and that increased revenue guidance, that reflects confidence in their own initiatives.
Right, things they can control.
Exactly, like the AI enablement, the growth in AI categories, the enterprise strategy. They believe these internal drivers are successfully offsetting the macro pressures. It suggests a somewhat, self-reliant growth path right now.
Okay, that suggests they feel they're navigating effectively. How are they balancing all this investment in growth, AI, M&A with returning capital to shareholders? That's always a tricky balance.
It is, and it's something they seem quite deliberate about. The company has shown a strong ability to expand margins, over 20 percentage points of margin expansion in the last 2 years alone. They are clearly investing heavily in organic growth like AI and Business Plus, and those are now showing, clear potential returns. They've also done what they call smart, inexpensive, high ROI M&A, those Bubty and Ascen deals to hit strategic goals faster. But on top of that, they've returned $170 million to shareholders via buybacks in the last 18 months.
170 million.
Okay. And they plan to continue being active with buybacks in the second half of this year. They also expect stock-based compensation to come down, which helps GAAP profitability. So it feels like a pretty holistic approach to creating shareholder value, balancing investment and returns.
So putting it all together then,
Yeah.
What's the big picture takeaway? Is this just one good quarter, maybe things lined up well, or is there a fundamental, maybe longer-term shift happening here?
I think the real aha moment beyond just the earnings beat is that the company sees this as building the foundation for accelerated multi-year growth. There's a clear narrative shift happening. They're moving from being seen sometimes as just a cyclical gig platform, up when the economy's good, down when it's bad, to becoming a secular AI talent enabler.
Secular, meaning less tied to the economic cycle.
Exactly. Driven by a long-term trend, in this case, AI adoption. They're trying to prove AI isn't just hype for them. It's their new core growth engine. It's fundamentally transforming them into what could be an indispensable long-term talent infrastructure partner for big companies. Successfully integrating Bubty and Ascen plus continued UMA AI adoption that could really cement this new identity. Key things to watch: Q3 earnings in early November, the Ascen deal closing, the beta rollout of enterprise ads, and broader macro trends like SMB hiring picking up or continued high demand for AI skills. Those could certainly add fuel to the fire. They're actively reshaping the business.
It really sounds like they're positioning for a significant re-rating in the market, trying to move beyond past perceptions into a whole new chapter. All right, well, that brings us to our This Is Not Financial Advice segment. This is where we pitch an outrageous but plausible trade idea, like a hedge fund analyst trying to make a splash.
Okay, let's do it. Given the strong beat, the raised guide, that strategic pivot we've unpacked, here's the thesis. Despite the stock sliding, 21% in the 6 months before this call, these Q2 results signal a fundamental re-rating is potentially underway. Like we said, the market's been treating it like a cyclical gig platform. But the story, it seems to have genuinely changed, driven by AI and enterprise M&A.
Okay, thesis is a re-rating, and your trade idea, the bold play.
The outrageous but plausible play is go long, but not just the stock. Specifically, long-dated, out-of-the-money call options.
Ooh, options. Okay, amplifying the bet.
Exactly. The thesis is that multi-year re-rating, as the market digests this shift and reprices the company as a dominant AI-enabled workforce infrastructure player. unlocking that huge $650 billion enterprise TAM. The boldness, the outrageous part, is expecting this stock, which is a bit of a laggard, to potentially become a sector leader based on these structural AI-driven changes. You're betting it could reach maybe pre-slump highs or even new all-time highs as that enterprise strategy fully plays out, helped along by buybacks and strong free cash flow. It's a bet on real transformation, not just a good quarter.
A transformation bet via OTM calls.
Got it.
Well, what a deep dive into this earnings call. So to recap, a standout Q2, record profitability, beat guidance everywhere, and raised the full-year outlook.
Exactly. These results really underscore the strength they're seeing from their AI and M&A strategies, positioning them, they believe, for durable, profitable growth in a massive enterprise market, even while navigating this tricky macro environment, largely through their own momentum.
And as always, everyone, remember, this deep dive is purely for informational purposes. It does not constitute financial advice. We're here to help you get informed, not tell you where to put your money.
Yeah, and maybe leave you with this thought. As AI keeps reshaping the labor market, will platforms like this one fundamentally change how all businesses acquire and manage talent? Could traditional fixed employment structures eventually become, more of a niche model, something to chew on?
A great thought to leave folks with. Thanks for diving deep with us today. We'll be back soon with another essential deep dive just for you.